That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves, get you up to speed on the action from today's trade. Yahoo Finance's Jared Brickley joining us now with the latest market action. Jared.
Thank you, Josh. Let's start with the Nasdaq Composite having its best day since May. That is 6 months. So pretty impressive day. It was up and away from the very beginning. Very similar story for the Nasdaq 100. Both of those up 2.6%. S&P 500 just a little bit less than that, about 1.5%. And the Dow pulling in the rear, but still up a respectable 44 basis points, or almost 0.5%. Also checking in on the small caps, we got the Russell 2000 nearing 2%. So pretty broadly bullish day, no matter how you slice and dice it. I think we'll move on to the sector action, where, not surprisingly, tech in the number one spot. The only outperformer here, second, we have consumer discretionary, utilities also flying high, then communication services. So utilities coming from behind there. Only two sectors in the red, really staples down 1%. That was the biggest one. Energy just down mildly. And let's take another look at the closing look at the Nasdaq 100. Alphabet, a record high, up 6.3%. Broadcom up 11%. Meta up 3%. Tesla up nearly 7%. So it was a really big day for the chip stocks, which we're showing right here. Lots of dark green on that board. Software, as I was pointing out earlier, not quite as bullish looking, not as much dark green, but still a lot there. And just checking out some of the smaller names as well. I just want to point out the meme stocks as a pretty good indicator of the risk-taking, I guess, whatever you want to call it, in the market that we're seeing today. We can also see that in what is the crypto space. So we're seeing some dark green in Ethereum, Ripple, Solana, not necessarily Bitcoin, but I think investors will take that given the downsides that we've seen very recently. And then checking out some of the sentiment indicators here, not surprisingly, Bitcoin up the most. That reflects everything since Friday. So Bitcoin that we were just looking at is since yesterday. GBTC is an ETF. So that is up 5% since Friday. ARK, that's a disruption trade, up 4.5%. Chip stocks, Magnificent Seven, Quantum, China, the Qs, biotech, all of those on the top, doing really well today. What is not doing well? That would be home builders and retailers, also low volatility, but home builders and retailers were leading late last week, so interesting to see that shift in tenor there. And I did mention that the bond market, the longer term yields were coming down there, so definitely not benefiting from those. I think I'll leave us off on China, which was another outsized winner today. Alibaba coming back for 5 percentage points, then Baidu up 7. So pretty vast swath of stocks, sectors, indices, no matter how you want to slice it and dice it, being really bullish today, Josh.
All right, thank you, Jared. Well, despite volatility, the bull market has been able to hold firm. Strategists looking past recent market volatility, expressing their bullish views for equities heading into 2026. For more on the market expectations, let's welcome in now Hennion and Walsh, CIO. That would be Kevin Mahn. Kevin, always great to see you, my friend, on set.
You as well, Josh.
Let's start here on the market. You note the bull market just hit its 3-year anniversary, and historically, you say, that is a positive milestone. So let's start there. I'll double barrel this one.
Sure.
One, just walk me through that. Explain that. Why is that a positive milestone? And two, I guess, Kevin, if I'm an investor, I hear that and I wonder, okay, so what are though some big risks that could maybe break that pattern?
Yeah, anytime I see a significant milestone like that reached in the market, Josh, I turn to my research team in New Jersey and I say, is this a good sign that better days are possibly ahead? Or is this a sign that the best days were behind us? In this case, it appears as though it was the former, as they were able to go back 50 years and actually see that there has been 5 previous times when a bull market has reached its 3-year anniversary. And in all 5 times, it continued to move higher by an average total duration of 8 years, which would suggest we got 5 more years to go. The shortest duration was 5 years, which would suggest we have 2 more years to go. And in 2 cases, we hit double digits in terms of total years of that bull market run. Now, of course, this time could be different. Past performance isn't indicative of future results. We know all of that. But there does seem to be multiple tailwinds that would support the markets moving higher. But I still contend that the areas of the market that led the first 3 years may very well not be the areas that lead the next 3 years.
Can I ask you, in terms of risk though, All right, history suggests positive milestones.
Yes.
What would be on Kevin's wall of worry there?
I think there's multiple walls of worry, and I don't subscribe to the AI bubble is about to burst camp. In fact, I think those investors who are fearful of an imminent bursting of the AI bubble, that fear is either misplaced, premature, or potentially even both. And if you're waiting for that bubble to burst, you're likely to miss out on the most significant returns that the AI revolution may have to offer. But the risks to me are, what does the Federal Reserve do or not do with respect to interest rates? Ultimately, what happens with US-China trade policy, and of course, valuations. Valuations remain stretched right now, and the money keeps going into the areas of the market that are the most stretched in terms of valuations. So I look beyond that. I look to areas like industrials, utilities, maybe some communication services name as well, because they're all part of the AI revolution, and they're not as stretched in some places in terms of valuations as some of the semiconductors and chip plays.
On AI, Kevin, I know you're in the camp that says, okay, this looks to you like early innings.
Yes.
Another strategist said, forget early innings. We're not even at the plate yet.
Batting practice, that's me.
Okay, let me ask you though, to that point though, my friend, what are, as an investor, what are the signals that you looked at that tell you this is early, not peaking?
Sure. So what I look to is Jensen Huang, the godfather of AI, the CEO of Nvidia. What he told us is that he believes there'll be somewhere between $3 to $4 trillion with the T spent on AI infrastructure investment by the end of this decade. So if we're at about 700 billion right now, to get to 3 to 4 trillion in the next 4 years, that's a lot of spending that's coming down the road. And where's that spending going to go? In the batting practice, the infrastructure build, the data centers, the power solutions, the cooling solutions. Not necessarily the AI algorithms and the hardware and the software plays. That's going to come when we start playing the games. And that ROI, Josh, won't be reached for years to come. So investors are going to have to be patient on that front and try and identify more winners than losers in building a diversified portfolio. But for now, the infrastructure play continues.
In some of those big tech AI plays, Kevin, we were talking off camera about this. Some of the divergences are really interesting. If you look in, for example, the past month, Alphabet's a rocket ship.
Yes.
But Meta's been whacked.
Yep.
Oracle's been whacked. And I'm wondering if that tells you what it tells you. Do you think that tells you, indicates to you, okay, investors are starting to draw harder lines here?
Absolutely. I think investors are trying to pick the winners now. And what they need to realize is that the AI revolution is going to be a very long road filled with many potholes. And like previous industrial revolutions, there'll be more losers than there will be winners. I think the losers, though, will be defined as those who either overspend or underspend. And the circular financing that's taking place within the world of technology right now truly is a survival of the fittest because they don't want to be left behind. But the best way to ride this AI revolution, I believe, is to make investments all across the AI ecosystem, including, as I said earlier, the data centers. How about the utility companies that are supplying the power to these data centers? The nuclear evolution that we're seeing, whether through small modular reactors or nuclear power plants. Build them all into your portfolio, incorporating power solutions and the AI ecosystem, and I think you'll find they have a higher likelihood of finding the winners and avoiding some of those losers.
I want to get you on the Fed.
Yep.
Here's what's interesting. So we have the meeting next month.
Yep.
And we had questions about whether there was going to be a cut. It becomes a coin toss, and all of a sudden we see these jitters in the market. Now odds go up, we think of a cut, and I've got green everywhere. Does that suggest to you that maybe we do need a cut for this market to move higher?
It suggests to me that the market wants a cut, and if we don't
Wants,
get that
but
cut,
doesn't need?
Wants but doesn't need. Now there's a 71% probability of a rate cut in December. If the market doesn't get that, we could sell off. But I think any potential sell-off because of the Fed not cutting is going to be greeted by more cash coming off the sidelines and likely running into those same areas of the market that have driven the market higher, and then we get a strong close to this year.
Finally, let's give the people some picks here, Kevin.
Let's go.
All right, Vertiv,
Yep.
Next Era, Olema Pharma, Aero Environment. Are there certain common themes
Yes.
there in terms of fundamentals or business models that tie those together?
Yeah, my theme for the balance of 2025 into 2026 is follow the money. Where is all the spending taking place? We know it's taking place with respect to AI infrastructure. There's Vertiv Holdings. They supply the cooling solutions to the data centers. We know it's taking place with respect to power solutions. We heard that the U.S. government is looking to buy 10 nuclear power plants. How about NextEra Energy? They own FP&L, and they actually own 5 different nuclear power plants themselves. Biotech. We continue to see more and more M&A activity taking place as it relates to large cap pharma buying small cap biotech. How about a company like Olema Pharmaceuticals, which is focusing on breast cancer treatments with 2 drugs in the FDA approval pipeline? And then lastly, as it relates to aerospace and defense, trillions of dollars to be spent on defense across the globe over the upcoming years. AeroVironment, unmanned, autonomous aircraft seems to be the wave of the future, and that's an area that we like as well.
Kevin, always great seeing you, especially on set. Thank you, my friend.
My pleasure. Happy Thanksgiving.
You too. Coming up, we bring you the latest headlines around Tesla and healthcare policy next on Market Domination Overtime. Tesla shares getting a lift in today's trade amid bullish remarks from Wall Street and CEO Elon Musk. Yahoo Finance's Praz Subramanian joining me now with the details. Praz.
Yeah, so the Melius Research buy call here, they're reiterating a buy here, basically saying that Tesla's a must-own stock based on full self-driving, autonomy, those types of features, right? So they're saying that autonomy or full self-driving or just cars going around by themselves in general is, the analyst Rob Wertheimer said, is coming very soon. And Tesla will benefit. So the latest version of that FSD is the Spark, and legacy automakers like GM and Ford just can't compete. And he talked about, we can talk about this a little bit too, but also Tesla sort of makes a lot of stuff in-house, right? Software, chips, whatever you want to say. But the opportunity here is big, right? So why isn't, what's this guy's name? Wortheimer. I knew I'd remember this.
The important, just the Melius.
Wertheimer said that it's a $4 to $5 trillion opportunity globally and $700 billion in the U.S. alone. So a lot of money at stake there, a lot of the transportation sort of future at stake there, and he thinks Tesla is the best position to do that.
I think he's called it a must-own. Here's the other headline, though. Musk goes on X. He's talking about AI chips. What's the story there? And did Melius refer to that in the note?
Yeah, so Musk over the weekend was talking about how Tesla is this global leader, right, in chip making, saying, quote, that most people don't know that we've been an advanced AI chip and board engineering team for many years, et cetera. Making these chips are going to enable Tesla to be the leader in real-world AI. They have an AI4 chip that's currently going to be in their newest cars. And the next gen chip, the AI5, will be in their cars in 2027. Now it's kind of a delay from what they were saying originally, but those are the chips that sort of both help train the AI and then also for inference purposes, how the thing operates in the real world, right? So that's a big deal. And also, and Melius, the analyst, Wertheimer, is that his name? Wertheimer, said, yes, Tesla's sort of advantage are making their own chips, taking a gamble, something that you wouldn't necessarily see the legacy automakers do is what Tesla does, and that's sort of going to pay off for them as they make the chips cheaper, they have control over it, can integrate the software easily, all that sort of thing.
Final question, though. Did Musk say anything about the AI chips that was new? Because I thought we already knew a lot of this.
He was saying something to the effect of like, no, the chips are being made for years. We knew about that. He was saying something to the effect of, we want to improve this every year, and we're going to make as many chips as possible. We want to get this the new foundry, which of course he's talked about before. So it's not anything new. It's just that he was sort of putting a focus on it. That hey, the chips are here and they're coming faster than we're going to say they are. Meanwhile, the AI5 chip has been delayed. So it's more of the Musk sort of thing where he's touting a big thing, but it's a timeline that matters.
Yeah, stock popping. Praz, thank you.
It doesn't matter, right? Yeah.
There you go. Meanwhile, mounting concerns about medical costs and affordability are brought into focus as the deadline for Affordable Care Act subsidies nears. However, President Trump reportedly looking to propose an extension to enhance subsidies. For more on what this means for consumers and insurers, let's welcome in here Raymond James, Managing Director and Washington Health Policy Research Analyst. There'll be Chris Meekins. Chris, great to see you. So I guess big picture, what's the significance, Chris, of Trump potentially supporting short-term extension of ACA subsidies? And I want to make sure I get this right, Chris. Why do you still put the odds of an extension below 33%, Chris?
Yeah, I'm the most bearish on the street and have been for, more than 2 years now. I think we wrote about it Halloween of 2023. And as you know, we've now passed 2 Christmas seasons, approaching our third. What I'll say is that what was reported today by a few outlets was that the president may be supportive of a 2-year extension with significant reforms. Those include capping the income at 700% of the federal poverty level, which is about, for a single person, $109,000. Saying that everyone's going to have to pay at least some amount each month. There's no longer going to be $0 monthly premiums. You'll have to pay something, which could be really significant and make a change. Saying that they want to refund these technical things, cost sharing reductions. And then in addition to that, looking for expanding HSAs if people downgrade their plans. What I will say, and it's very important, and why we have to be very careful about making stock choices based off of just some reporting, is that the president hasn't come out and said any of this. And the White House today, and I'm going to read it so I don't get it wrong, press secretary said, as you know, sometimes people report things and then President Trump comes out with an announcement, and those things are not always true from what you hear from sources inside the building. This implies the White House is still making changes to what they may support at some point. Back in 2017, former Speaker of the House, John Boehner, said as he was leaving, in his 25 years in Washington, he never has seen Republicans unite behind a health care package. And I think that is something we need to keep in mind, just how challenging that is.
Yeah, the caveats you mentioned, Chris, well worth hearing and listening to. The reports have outlined, though, a few different pillars. You've seen this, right? So it looks like income caps, minimum monthly premiums, funding CSRs, HSA expansion. What does that mean for the insurers, Chris? How do they walk through this and think about it?
I think it's complicated. Insurers want to see an extension. If there was a clean extension with just 700% of FPL, they would be very happy with that. The minimum monthly payments is going to be a challenge. And I think what you're going to see is if that were to go into effect, you'd probably have millions of Americans, maybe up to 5 million, fall off the exchanges. And these would likely be the low utilizers. So the people that are paying a premium or having the government pay a premium for them, but not utilizing any medical costs. Those are insurers' favorite people. You get money, but you don't have to spend anything on it. And so when we look at these potential changes, I think there is a scenario where the fix may actually be worse than just the expanded subsidies going away for the health insurers. So while I saw Centene and Oscar were up today, notably, I would be a little more cautious about the potential reforms that are being thrown out there.
I'm also interested, Chris, to get your take on the politics of all this. Democrats, where do they stand on this, Chris? What are their big objections? Is there a version out there that they could get behind?
Maybe. If you were to ask me the Democratic Party of 5 or 10 years ago, I would say, they'll look at whatever can be done to help the most people and move on from there. What we see potentially the Democratic Party going through right now feels similar to me like what we saw the Republican Party go through as part of the Tea Party in 2010, where Republicans then would not they would instinctively oppose anything President Obama did. And if you supported anything then Democratic President Obama did, you were viewed as an outcast in the party. The similar action seems to be happening now with Democrats and President Trump. We see the parties becoming more polarized. And if that's the case, then Democrats may rather have the campaign issue in the midterms to talk about how Republicans, didn't extend these and millions of people are now paying more, rather than actually just helping a subset of that group of people.
What's the timeline here, Chris? As investors, I need to monitor. Are there certain key dates and legislative windows on the calendar?
The expanded subsidies end December 31st. So January 1, they're gone. Doing it retroactively is far more complicated. Even implementing something now would be incredibly challenging if you're doing any types of reforms. Majority Leader Thune, Republican, promised Senate Democrats when they agreed to reopen the government that he would give them a vote on any bill they wanted related to expanding and extending these subsidies. That vote's expected around December 11th or 12th. Open enrollment ends the 15th for some people. So I just say that during the next 2 to 3 weeks, especially after Thanksgiving, it's really going to heat up in the rhetoric about what may or may not be able to get done. I'm skeptical they have time to get this across the finish line. And like the expanded child tax credit during COVID, I think this one's going to go away.
Chris, big important story. Thanks for helping us think through it. Appreciate it.
Thank you.
All right, time now for what to watch Tuesday, November 25th. We're going to start off on the economy. We're going to be getting a rush of economic data on Tuesday, including the delayed U.S. retail sales report for September. Economists forecasting retail sales to slow compared to August to 0.4% on a month-over-month basis, signaling that spending is still growing, but at a cooler pace than the previous month. And speaking of retail, a lot of earnings coming out on Tuesday, including Dick's Sporting Goods, Best Buy, and Kohl's. Dell also reporting announced results for the third quarter after the markets close. Analysts expecting Dell's AI server sales to drop to $5 to $6 billion in Q3, down from $8 billion last quarter. But new orders could pick up again soon because big AI projects tied to Nvidia's new Blackwell chips. And moving over to housing, we're going to be getting pending home sales data for October on Tuesday. That number expected to move to 0.4% for October, suggesting a modest improvement in the housing market. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.